Russia might be the most sanctioned country on earth. Frozen assets, locked out of SWIFT, global banks won't touch them. Visa, MasterCard, gone. So how are they still trading oil? How are Russian companies still moving money around the world? One word, crypto, but not just a few wallets. We're talking about a hidden stockpile estimated in the trillions moving through backchannels, OTC desks, shell exchanges, and stablecoin swaps, a shadow banking system. Built in real time, at its peak. Analysts estimate Russia may have moved over $2 trillion worth of crypto on and off the books to keep the lights on, but then something snapped. The market turned, Bitcoin crashed. Rust wallets got flagged, and Russia's crypto pipeline? Jammed. The sanctions didn't fail, they just got rerouted. And now? That $2 trillion shadow reserve is under siege from regulators, blockchain analytics, and crashing confidence. In this episode, we're going inside the world's biggest off-ledger war chest and asking, what happens when your entire sanctions strategy is built on an asset class that collapses overnight? Since 2022, the West has thrown everything it has at Russia's economy. Sanctions, asset freezes, SWIFT bans. By 2025, over 13,000 restrictions were in place, the largest financial blockade in modern history. But here's the twist: Russia didn't collapse. Despite losing access to dollars and euros, despite being cut off from global banking infrastructure, Russia kept trading. Oil, gas, metals still flowing. So how? The answer wasn't gold. It wasn't yuan. It was crypto, Bitcoin, Tether, Ethereum. Not as speculation, but as infrastructure. Russia used a patchwork of OTC traders, proxy wallets, and compliant exchanges in places like the Way, Turkey, and Southeast Asia. The goal? Move money without ever touching the Western system. And it worked. Ruble to Bitcoin desks flourished. Russian energy firms accepted stablecoins through shell entities. Even state-aligned banks explored blockchain rails for international trade. For a while, it looked like Moscow had found the perfect loophole. And if you were watching crypto markets between 2022 and 2025, you saw something strange. Price surges that didn't match retail interest. Massive stablecoin flows with zero media coverage. Wallets moving billions but no name attached. Then came the rumor. Russia had quietly built a crypto buffer. A $2 trillion stack of digital firepower spread across wallets, proxies, and cold storage. Was it real? Hard to prove, but the pattern fit until it broke. By early 2026, crypto markets had started to unravel. Bitcoin dropped below $25,000. Stablecoins came under regulatory fire, and the tools Russia relied on suddenly became liabilities. The question now isn't just how they pulled it off. It's whether they can survive what's coming next. Because if your war economy runs on crypto, what happens when crypto cracks? Up next, we break down how the entire system worked step by step, who helped, how money moved, and where the weakness finally showed up. To understand how Russia pulled off the most sophisticated crypto maneuver in economic history, you need to follow the trail most investors never see. It didn't happen on Coinbase. It didn't happen in Moscow. It happened in the shadows across a web of OTC desks, shell exchanges, and token swaps. Here's how it worked. Step 1. Rubles out, stablecoins in. Russian banks under heavy sanctions funneled rubles through domestic exchanges still operating under the radar. These exchanges didn't go straight to Bitcoin. They went to Tether, a stablecoin pegged to the dollar, accepted worldwide and easy to move. Step 2. OTC brokers in friendly jurisdictions, think Dubai, Istanbul, Singapore, took those stablecoins and converted them into usable currency. Yuan, dirhams, sometimes even dollars. From there, the money flowed to import-export businesses, oil tankers, arms deals, all without ever touching a SWIFT wire. Step 2. Disguise the trail. Unlike traditional banking, crypto leaves a public ledger, but Russia had a workaround. They spread funds across thousands of wallets, used mixers, cross-chain bridges, and routed through exchanges that didn't comply with U.S. rules. Platforms like Guarantex, which the U.S. Treasury sanctioned, kept operating, mostly from outside U.S. jurisdiction. Step 3. Cold storage and decentralization. Major state-linked entities began storing crypto offline. Why? Because it couldn't be frozen. Unlike gold held in London or cash in Swiss banks, crypto in cold wallets stayed out of reach. By late 2024, intelligence reports suggested Russia's crypto stockpile could be in the hundreds of billions, with broader flows exceeding $1 trillion over 3 years. Some analysts say that number could have peaked at $2 trillion, including all ruble outflows converted into crypto across private and public channels, and nobody could stop it. That was the power play. Crypto wasn't just a workaround, it was a parallel system, one the US couldn't fully track, much less control. but there was a flaw, because crypto isn't magic. It's still tied to market confidence. And when prices cracked, regulation tightened and on-ramps started freezing. That whole system started bleeding. Up next, what broke when it broke and how that exposed the weakness in Russia's trillion-dollar strategy. The system was slick until it wasn't. In late 2025, crypto markets started to wobble, not because of Russia, but because of something deeper: confidence. Bitcoin slipped below $30. Ling ling ling. Ethereum lost half its value in 3 months, and stablecoins, especially USD and USDC, came under fire. What triggered the collapse? Regulators worldwide started asking the hard questions. Where's the collateral? Who's issuing these tokens? And most importantly, who's using them to dodge sanctions? That last question led straight to Russia. In December 2025, the US Treasury and EU banking authorities launched a joint investigation into crypto-based sanctions evasion. The first target: wallets tied to Russian state-owned enterprises and defense contractors. The second: OTC brokers in Dubai and Hong Kong. Suddenly, wallets started getting flagged. Tether froze specific addresses, some holding tens of millions. Gateways Russia relied on began to vanish. Even decentralized protocols weren't safe. Bridges got shut down. Mixers were outlawed. And with each headline, crypto's off-grid illusion cracked. Then came the liquidity squeeze. As panic spread, stablecoin liquidity dried up. Traders didn't want rubles. They wanted dollars. And the only path to dollars from crypto was shrinking: Russia's silent reserve. Still on-chain, still visible, but increasingly non-transferable. What good is $50 billion in Tether if no one will swap it? Worse, prices dropped. Between December 2025 and February 2026, the average portfolio in Bitcoin, ETH, and USD lost between 25 to 40% of value. If Russia was holding $500 billion across crypto assets, they may have lost over $150 billion without a single missile fired. That's the twist. The same technology that gave Russia escape velocity from sanctions also exposed them to uncontrollable volatility. Buffett once said, "Only when the tide goes out do you discover who's been swimming naked." Well, when the crypto tide went out, it wasn't just retail investors caught off guard. It was a sovereign state betting its financial survival on a blockchain. Coming up next: who gained from Russia's collapse and who's still holding the bag. So who came out ahead? And who got wiped? Let's break it down, because this wasn't just a Russia story. This was a global stress test for how real crypto power really is. Winner number 1: US regulators. For years, they were chasing ghosts: offshore wallets, anonymous tokens, decentralized finance. But in 2025, they finally got traction. By freezing us to addresses, pressuring centralized exchanges, and tracking chain analytics through Chainalysis and Term Labs, they found the leak and plugged it. The result: for the first time, crypto became geopolitically traceable. That's a huge win for Western enforcement. Winner number 2: US Treasury bonds. As the crypto pipeline collapsed, where did money flee? Not into gold, not into yuan. It fled into treasuries. Ironically, Russia's crypto unwind drove demand for the very system they were trying to escape: the US dollar. Winner number 3: on-chain surveillance firms. Palantir, Chainalysis, Term. Every major Western intelligence partner that helped map the Russian flow is now flush with government contracts. When crypto became a battlefield, data became the weapon. Now, the losers. Loser number 1: the Russian state. They thought they'd built a parallel system. They actually built a trap, a system reliant on foreign exchanges, foreign liquidity, and foreign regulated tokens. Their supposed $2 trillion crypto buffer. At least 30 to 40% of that is now frozen, devalued, or inaccessible. That's hundreds of billions evaporated. Loser number 2: retail investors in friendly nations. People in countries like Turkey, Argentina, and India, where crypto became a lifeline, got caught in the crossfire. Regulators didn't just block Russian wallets. They choked off access for anyone using OTC or DeFi channels viewed as risky. Tether depegged briefly, exchanges shut down accounts overnight, and portfolios got slaughtered without warning. Loser number 3: crypto's reputation as a sanctions escape hatch. This was the test, and it failed. Crypto didn't stay neutral. It didn't stay uncensorable. It didn't stay offshore. It became another battleground with clear winners and losers. Now for your wallet: if you had exposure to BTC or ETH during this period, you likely watched your holdings drop 25–30%. If you were using stablecoins as savings, some platforms froze your access. And if you were in DeFi yield strategies linked to USD or USDC, well, you probably don't want to open that portfolio right now. This wasn't just about Russia losing. It was about every crypto holder discovering how fragile the system really is when power comes knocking. Coming up, where things stand right now and what might be Russia's next move. It's 2026. The dust hasn't settled, it's still flying. Russia hasn't confirmed the size of its crypto reserves, but blockchain data, OTC volume analysis, and leaked reports suggest the number was real and massive. Between 500 billion and 2 trillion flowed through crypto channels linked to Russian actors between 2022 and 2025. But here's the problem. Almost none of it is moving now. Let's look at on-chain data. Wallets flagged as high-risk Russia linked by Chainalysis have been stagnant for months. Tether addresses. Frozen by the US Treasury? Over $240 million locked, just the tip of the iceberg. And Garantex? Still operational on paper, but global volume is down over 85% since sanctions tightened the result. Crypto may still be decentralized, but for Russia, the network has become a prison. Assets exist, but can't be traded, can't be converted, and can't be used at scale. Meanwhile, on the legal front, the Russian government is scrambling to build a new crypto framework. They've legalized certain forms of cross-border crypto payment into 026, but with strict state oversight. They're pushing domestic mining, trying to build a ruble-backed stablecoin, but it's too little, too late, because the world is watching. Every wallet flagged, every transaction analyzed, every OTC desk monitored. Even China has distanced itself, warning banks and exporters to avoid high-risk crypto exposure. And what about the broader market? Bitcoin's down, Ethereum's volatile, but the biggest impact is confidence. The idea that crypto could serve as a neutral store of value is gone. It's not gold, it's programmable money with a kill switch if you're on the wrong side, for everyday investors. That means less freedom, more surveillance, and a reminder: when governments want control, they will find it. Coming up next, the 3 moves you can make right now to protect your money from the next geopolitical collapse. So what do you do now? How do you protect yourself in a world where crypto isn't safe from politics and trillion-dollar war chests can vanish overnight? Here are 3 strategic moves you can take today. Step 1. Diversify outside the chain. If all your money lives in crypto wallets or DeFi platforms, you're exposed. Yes, it's decentralized, but as Russia learned, decentralized doesn't mean untouchable. Keep a portion of your assets in traditional, regulated vehicles, treasuries, I-bonds, cash equivalents. They might feel boring, but they don't freeze when geopolitics gets ugly. Step 2. Watch wallet behavior, not headlines. Don't just read what politicians or crypto influencers say. Track what wallets do. If high-volume stablecoin wallets start freezing up or OTC desks go quiet, that's your warning sign. It means the liquidity you rely on might disappear next. Use tools like Arkham, Nansen, or Whale Alert. If Russia's wallets stopped moving before the collapse, so can others. Step 3. Know your exit ramps. Ask yourself this: if crypto crashed tomorrow, could you get your money out? Know your exchange limits. Understand stablecoin risk. Check your fiat off-ramps. Because if your portfolio's locked in protocols with no path to cash, that's not freedom, that's a trap. Now look, this doesn't mean crypto is dead, but the myth of crypto as a neutral, apolitical escape hatch, that's over. The Russia case proved it. When governments want to shut it down, they don't attack the code, they squeeze the rails. Tether, bridges, exchanges, wallets, choke points everywhere. So build your plan before the next political crisis hits. And if you want to stay 2 steps ahead of the collapse, subscribe now. Next episode, we will be breaking down how India's digital rupee is becoming the surveillance model for 2027 and what it means for your privacy and your money.